let's start with the prediction markets. Maybe first of all, who of you has used the prediction market before or already? Can I see? I see 2 hands, 3 hands,
5.
5. Okay, so maybe half of the room already have touched the prediction market and tried it out a little bit. Yeah. Maybe up front a quick experiment. Let me jump into it. When I would ask you kind of the question, will a human set foot on Mars before 2035? That would be kind of my introductory question. Who of you believes that? Please raise your hand.
1, 2, 3. 5 again.
5 again. And if I would now ask these kind of the people, how much money would they put behind each of these raised hands? And the other people who don't put up the hands, would they also vote for no?
Who would vote for no?
And what would be the money you put behind you would put behind it? Would be a lot? Would be a little less? What would happen in your head? Would you do some more research about it, or would you just kind of YOLO in the money?
I'll probably do my research for it. I don't know if you can hear me.
Yeah, I hear you.
Yeah, I'll probably do my research since I have no idea about the technological development on the Mars. So where we stand with the how far we are from the landing to the Mars. So once I'll do my research, I'll probably put a lot of money for it, but right now, just a little.
Yeah, makes sense. And probably the more confident you would get, the more money you would put in, because you could maybe then make some money out of it. That's kind of the whole thing about a prediction market, more or less. We go into detail in a little bit how then the whole mechanisms about it work. But in the end, it's kind of a question which kind of many people answer. And behind each answer, they will put money. And more confidence they have, the more money they would put behind it. But if there is no money involved, you would just raise your hand and would just give your vote out with having no consequences. And I think that's kind of the idea behind a prediction market, to get the wisdom, kind of the crowds with the and put money behind it in order to see, okay, what does a huge amount of people or experts know about it? Yes, and that's why that's kind of the agenda I'm gonna go through today, the different blocks we're touching. So first of all, I will go in introduction, what are prediction markets, go a little bit deeper now, what we just recently touched with the example question. Then I dive a little bit into theory, but I don't want to get you bored about that. Then one more important building block is then the third one. That's kind of how you build prediction markets and what are the different building blocks in there. And then in the end, I just want to give you a little outlook how it could be and how prediction markets could be evolved in the future. Okay, let's come in. And don't forget to ask questions if there are any questions in the room, please. Okay, this first study. And for that, I would just quickly show you Polymarket, how it looks like. This is kind of the most used platform right now, built on crypto rails, is Polymarket out there. And as you can see, if you go here into Polymarket, it's loading. Do you see my screen? I think yes, it works.
Yes.
You can browse to all kind. You see, kind of there are all kind of different questions asked. Is it big enough? Or isn't it?
Yeah, it's good. We have a large screen here.
Yeah, this is kind of the platform everybody knows now in crypto and uses for prediction markets. There are many more coming up, but this is the most famous one. And as you can see up here, we have kind of all various categories. We have politics, sports, finance. We can go finance. We can have crypto, geopolitics, earnings, tech, culture, a ton of different stuff. Oh, my internet is very slow. Not the best here. Yes, and then you can. And then you can just browse through and you see, okay, all kind of different probabilities if an event will occur to a certain date. And so you can really think about all kind of different categories with all kind of different questions, like a Fed decision in December. And we can look into that, and then we will see, okay, there's probably that there is a 25 bips decrease in December is highly likely, and the crowd gives it a 68% probability. And how now does it exactly work? Like if you would give a vote onto that. Here I went with another question that's kind of which company has the best AI model end of 2025? And like we do it before, like with the yes and the no question, like I asked in the room. If we now, for instance, we see, okay, it's a 77 cents costs you a yes share. This is kind of you wanna bet on the outcome that that Google has the best AI model at the end of 2025. You would pay 70 cents. What you can do now, you could win when this is the case at the end of the year, you would get $1 back. So you kind of make an upside of 23 cents. That's a roughly 30% on the money you put in. If you would bet against Google, you only have to pay 24 cents for the share. But with that, you would have a much bigger upside. But of course, you would only put in the money on the no if you're sure that in any other company will release soon another better model. Like if you would imagine that maybe ChatGPT has maybe ChatGPT 6 ready, and they would release it at the end of the year, and you're pretty sure you're like an insider or whatever, and then you could make a ton of money because you think, okay, that's definitely beat Gemini 3 that just came out recently. And that's kind of this is kind of the core mechanics behind it. So you have always a question with a yes and a no answer, and you're gonna bet onto that. Like a prediction market, I framed that you can imagine it is kind of a, I mean, like you saw, it's kind of a stock market, but the difference is, I mean, on the stock market, you also kind of trade always the future, the future of the company. So there's never about now. It's always about the future. What is the company going to reach in revenue in the future? All this hopium in the market, like for Tesla and so on. And here with the prediction markets, it's kind of similar, but you have really dedicated questions of future outcomes. So it's really important to have future outcomes in there. And because people need to be interested into that, it's always kind of, it has some public interest. So you wouldn't ask some random questions nobody knows about and nobody cares because nobody would know anything about it. It's always anything public interest, like elections, sports, could even be the weather or the AMMs or what we have seen in these different categories. In a nutshell, it's like really having an end date. So the end date is very important here. So it always has to be clear. So it needs to be kind of a clear question. There are no questions about how to answer it when it kind of reaches the certain point in the future. Then we're having a binary market. So we have yes and no. Is it okay, my voice? I hear myself. Is it okay? Does it come through?
Yeah, perfectly.
Okay. So we have a binary market. So we have yes and no questions. So even when we go into Polymarket, you see always, even here, the 20% of a pips decrease here, this is always a yes, no. So they're kind of different. All these questions are always yes and a no, yes and a no, yes and a no. So we have kind of always this binary structure. It makes it much easier. Even put it on blockchain. You can have different ones, but it gets very complicated to trade. So this is kind of the common state right now, using always these binary and then kind of splitting these questions with different answers so people can bet on them. And then a very important thing here, just going back to the full screen, is that like you saw with the AI model question, there's always a winning share value. So in the end, when a market resolve it's over, you will get a certain amount of money. In the case of a Polymarket, it's 1 USDC. So one of these tokens here, that's a yes and the no token, will have in the end the value of 1 USDC and the other has 0 USDC. And here's in between, it always trades between 1 and 0, 1. But there's a really fundamental rule, and this is important. that the prices of these tokens together, there should never be more than one USDC, because otherwise you can just take all the money out of the market. Because imagine you would get, if you buy a yes and a no token, and they would give you kind of more money than the one USDC, you would always make money. So you're buying just both shares, and you're just running away with the money, and in the end, the whole market is gonna lose. Prediction markets are actually out there for now some longer time. There was one. There's the university from Iowa, and they kind of started with electronic markets, was it back then called, for predicting the election, and let students predict on that. And that was already in 1988, and that was actually a great success, because it was kind of the first time they said, okay, that actually really works. People not just raising their hands and voting on it. If you put some money incentive behind it, you have actually very good results coming out. That was kind of the first exploration in this field. And then actually in 2021, there was already coming a big prediction market coming out. It was in the US, and that was kind of for sports trading, but it led bet all around the world. But then the authorities were against it and had to close it again. And then it was calm for some time. And then in 2015, with the rise of Ethereum and everything, and they saw, okay, the programmability, there was Gnosis and Augur coming out, and they were building out the first prediction market frameworks for the blockchain. But it took another couple of years, actually to 2020, when Polymarket, the example I showed you, got them really successful, because the issue in the beginning with Ethereum was it was so slow, it was so expensive to do all the transactions, so it not really took traction. And first, when Polymarket launched on Polygon, that's kind of a sidechain to Ethereum, then it started to get traction. More and more people started trading on that whole thing. There are, right now, to give you a quick overview, there are two big players in the market. One is kind of the centralized market player, and the other one is the decentralized. The decentralized is the Polymarket market, more or less. They are kind of valued now very big, and everyone is waiting for an airdrop. They have a valuation around 15 billion. And on the other side is Kalshi, who is also cooperating now with Robinhood, and they got a valuation just recently, 11 billion, and raised 1 billion total funding. Don't know what they do with all that money, but it's definitely mean there's a lot of traction right now in the whole prediction market ecosystem, and more stuff gets built around it. And there's always the question I get asked many times: what is the difference between a prediction market and a betting market? And I mean, a betting market is already out there for a very long time. Huh? We have in UK, I think they're betting on everything. What dress is the queen wearing the next day, and so on. And we have all these different wherever you can bet on. But the thing is, the big difference is with this, I think they are kind of shaped for entertainment and profit. And the objective of that betting market is actually that the bookkeeper or the bookmaker makes money. So why they create this market? Because they want to get money. And I see prediction markets more like the way that a prediction, you want to get the information about what becomes true in the future, and you are also willing to pay experts for that. This is kind of my differentiation. I don't know if this makes sense yet for you or not. You can just have a question, but you will see later how a prediction market is constructed and what are kind of the flaws into it. And there you will see, okay, if it's not really set up or you don't ask the right people, there's also a high chance that a market creator can lose money in that. Okay, and why is it good to build prediction markets in general on the blockchain? I mean, first of all, as you know now, it's kind of a decentralized settlement. You can just put out the question and it just runs. It cannot taken down. It's just there. You know, it's very transparent and verifiable, so nobody can tweak around the market, kinda. We also have the censorship resistant thing that everybody around the world can kind of trade onto it, and there is just no one taken out of the market, so you can really gather all the experts around. Nobody needs kind of a KYC in that sense. Yeah, and that's why it's and all the whole, I mean, it's not there, but all the trading mechanism, how you set it up and so on, is definitely very good, tailor-made for the blockchain. Yeah, but what is kind of the theory behind these prediction market, and why does it work? I mean, in general, how it works, you're having kind of all these beliefs out there. So people believe into something, or have opinions, have informations about it, and they're gonna go and they're gonna see, okay, these are kind of the prices. And I think, okay, this price is pretty low, and I can definitely make a ton of money because I'm just smarter than anyone else and I have the information. So I'm gonna buy these token prices, and these kind of token prices then lead that these probabilities occur. And so it's kind of the flow. Okay, I'm smarter, I can make kind of money, or using that, and out of that, the crowd kind of aggregates all these probabilities together. And there are three concepts, kind of. They can come in a second. Behind it, I will go into it. But I think a very, very, very powerful tool is definitely these incentivized structures we're having. If you're having, I mean, maybe you felt it before in the little experiment we do. If there is no money behind it, everyone just votes. Just no skin in the game, is nothing. But as soon as there is money involved, people definitely will do better their homework and don't throw the money away. Of course, we're having kind of some herding behavior, and people just chip in and they have a gut feeling doing that. But as soon as there is bigger sums evolve, or you want to play the game, you go do your homework, you're getting information correct, and then you just start participating in these kind of the markets. There are kind of these three theoretical foundations behind it. One is kind of this efficient market hypothesis. Was there a question?
No, not yet.
Oh, okay. Let me know if something is unclear. I don't see you anymore. Or can I? Oh no. So I have a little bit of feeling what's going on, but then I have to go look to the left. Oh. Yeah. And we have efficient market hypothesis, wisdom of the crowds, and Bayesian updating, and they all kind of lead to it. That kind of prediction works. That's kind of the theory behind it. That's when you want to read some textbooks about it. Just in a nutshell, I mean, that all comes also from finance. We have the efficient market hypothesis, and this more or less means that nobody is smarter than the market. So actually, what that would mean is, on the stock market, all the prices are there, and you cannot be smarter than the stock market. So in the end, the question? No.
Nope.
No, okay. So in the end, and I mean, you see that kind of all information they are out there already baked into the asset prices. So even if you see ridiculous valuations on the market, they are kind of justified by the market. And I mean, and this thing comes also from there, that any fund in the world, or a fund manager, they really, I mean, it's pretty hard to beat just the normal market. And that's why you could have outliers, but they're all the time then coming back. I mean, there are some exceptions like Warren Buffett, and so on, they beat it, but in the end, you never be better than the index. And I mean, there are some things that don't work in the short run. That you have behavioral biases. It's hurting, you're jumping in, you hurt, and you trend, and then you have kind of these exaggeration on the market. They lead to anomalies, to bubbles or crashes. They could happen. There could be market frictions in there, and so on and so on. But in the end, this is kind of one pillar behind prediction markets, that kind of all the informations get back into the asset prices, and so you will have kind of the best probability projection for the future. And then there is the other one, I mentioned it before, is kind of the wisdom of the crowd, and I found it very funny, or to read about it, because the more people you're having on certain topics, like there's a mug of, or a glass of jelly beans in there, and they let people just guess onto that how much is in there. And the more people you're having, even you're having outliers, they're guessing, oh, that's 5, or the other one was that it's 5 million. You will just end up when you average out everything, or you take the median out of it, you will come a pretty good guess on the number on the number of jelly beans in the jar, without anyone knowing how much is in there. And this is just like, because you're taking many people with different diversity in there, they're kind of having independent guesses on that. And you also then need to choose the right aggregation mechanisms. And this is kind of somehow baked into a prediction market as well. And the last one, this is very, very theoretical, and don't go into this into this theorem now exactly. That was from Bayes. Yeah.
Sorry, Philip, there is a question. Could you go here?
This one?
Sorry, I do have a question. I was wondering, because I heard about this experiment with the jelly bean, and what I heard is that if people can beforehand talk about or discuss it somehow, the experiment doesn't work anymore. So by talking together, they create some bias. And I was wondering if you are familiar with this form of the experiment. What do you think? Because the Polymarket prediction markets are all about discussion, or like the discussion forms the price, right? So I don't know. My question is, what is your opinion about this?
I mean, you're totally right. I should have. This is kind of the independence of the guesses. It's kind of like anchoring, huh? You're going into a room and you're putting the number out already, and then everybody is kind of stuck in this number. And maybe when everybody already get a clue about it, then everybody thinks around this number. And so you need to keep them independent from each other. So you would just never let them talk to each other before. That's what you meant. Thanks for adding that. And you're right with the Polymarket. Of course, you're getting kind of some bias already because you see the price numbers. But I think because there is money behind, and you're trying to put effort into it to get smarter than the people, because you want to take money out of it. So you don't go with the herd. So if I see the guess, okay, is the best AI model is now from, I mean, now it's probably clear that in 2025, Google will win that. But maybe beforehand, it was like I would probably do my research even more in getting smarter and trying to get an independent answer. But on the other side, yes, of course, you kind of herded away. But I think if you taking also into account that everyone can participate from around the world in different groups, in different bubbles, you're getting, of course, you have the price already, but you're having these different, more independent groups, instead of just getting the expert from the MIT together and giving your opinion about one question. But I mean, you're right. The more independent, and you probably, if you would leave away the price and the probability, it would be probably better if somebody would give a guess. But then it's just hard to bake in the money incentive. Does it make sense? So it's just like, yeah, it's complicated. But you're 100% right.
Thank you very much. That's helpful. Thank you.
Great question. Thank you.
Yeah, very good question. Any other question regarding this topic?
Nope.
Okay, so we kind of having this efficient market hypothesis. We're having kind of the wisdom of the ground, and the other one is like, of course, when there is a new belief, something new coming in the market, some fundamental information, then this should then update, of course, the probability. And this is kind of what the Bayes terms kind of says. So new information leads to change, but I mean that it's kind of obvious in here. Yeah. And because of these kind of things baked into these prediction markets, it's kind of sad, and studies have shown that kind of these prediction markets, that they produce better probabilities than kind of experts around the world. But of course, it needs to be the prediction market. There needs to be enough liquidity, so enough people can be active on that and trade on that. If you don't have a lot of people and you don't really get the right experts, it just doesn't work. Then you have also the issue that you can, of course, I mean, that insiders can dominate kind of the market. Who knows the most can just force the market. And it comes also hand in hand, these insider, with manipulation risk. Because when you're having a ton of money, you can move the market. And like we have seen like before, that's this anchoring moment. No, I don't know your name. Sorry for the question. But yeah, like he meant, when you kind of can change the price and therefore the probability already, and then you just tweak everything. Trump will win, of course, because I put a ton of money, and then everybody thinks that you kind of manipulate this prediction market as well. So this is always things to keep in mind as well when regarding prediction markets. But in general, it works like evidence have kind of shown. Don't know which evidence this was exactly, but these prediction markets work just better than normal expert opinions. Yeah, that's kind of the theory about it. Now I would go deep a little bit into how to build a prediction market. Maybe just a quick question in between. Is it clear what a prediction market is? Did I miss maybe the beginning? I don't know. I spent so much time thinking about it. So if there's anything unclear, just let me know before we going into the challenge build. No. Okay, nice.
All good here. Thank you.
Yeah, I just wanna. I don't stay so much in the code because I think that everyone of you can do then afterwards. But I just opened it quickly. I mean, in the challenge, we having kind of 3 parties in here. It's kind of the user who's gonna participate in the. Let me open quickly incognito window to have another burner wallet. I hope you're all familiar with Scaffold Eve right now. Doesn't open. Yeah, we kind of having 3 parties in the prediction market participating. That's kind of, course, the user who's kind of playing or betting or just giving her the information into the market. Then we having a liquidity provider. Then we having a liquidity provider. I don't know why this doesn't work right now. My Next.js doesn't want to load. Okay, then whatever. It doesn't matter. So just briefly, the user participating, we have a liquidity provider because we need some money in there you could take out and you can gamble on, and also then provide the tokens. And we have the Oracle. The Oracle is kind of important to bring kind of the resolution on chain. So then let's go back into here. This is kind of from a user perspective, or but if you're looking at kind of the building blocks, you need to pay attention to when you're building it, you're having 3 important parts. It's kind of the tokens and all the mechanisms behind it. So how you can trade, how you can provide the liquidity. We're having the Oracle, which is very important, but comes very short-handed in here. It's actually a very easy concept, but actually very complicated to realize. And then we're having the whole around the trading the tokens. What kind of mechanism you're using? Is this an automated market maker, or is it even an order book like Polymarket has? That's kind of the core components. But now let's break them further down. How a prediction market is set up. So first we have kind of the setup for the whole prediction market. So what are kind of the core variables and the core instances we need in the beginning. Then we having kind of the tokens and liquidity. We're having the Oracle, trading mechanisms. And in the end, I want to just give you some final considerations, how to build a prediction market then in production and what are kind of the things you should focus on. So let's start with kind of the setup. So for the setup, we need a kind of we need to define who kind of the liquidity provider is. The liquidity provider is the person, we will see that in a second, who offers the money in the beginning, and the money backs then the tokens. So when we want to buy a token out of it, and this costs in a probability of 50-50, we just say, okay, we put is one. The winning value is 1 USDC, like before in the example, and we're saying, okay, one token is 50 cents and the other token is 50 cents. So this is kind of the start of the prediction market. We say it's a 50% probability. Then if you're taking out one token, and now the prediction result is to yes, and you took out the yes token, then someone needs to pay the yes token holder 1 USDC out. So this money needs to be there. It needs to be already for there. So otherwise the person couldn't win anything. And that's where liquidity provider comes into play. Then we have the Oracle address. We need to say, okay, who is willing to report the result to us? We have a question, and to the question actually is always, that's a tricky part in the end, because you need to define a question which is clearable answering and doesn't leave any room for leeway, and also has kind of the fixed state baked into it. And this is also the reason, I mean, I was talking about permissionless and all on the blockchain and decentralized, why Polymarket and most of the prediction markets are just not permissionless, that everyone can put their question, because it needs to be very curated and make sure that these questions also can be answered. Then we need to define a kind of initial token value for the winning token. So in this sense, like I said, it's one USDC. Could be also everything. It could be an ETH. Also, you could set up the prediction market with ETH. We kind of have an initial probability we need to define in the beginning. With that, I mean, like an example, I said 50-50 cents. Then we have 50%, but maybe we know already the outcome is more skewed in the one direction, and we say, okay, but actually that their humans will be on Mars at 2035 because of the evidence. We think, well, rather it's kind of more already in the range of the 80%, and so we would let the market start with 80%. So we have kind of 80 cents you need to pay for the yes token and 20 cents for the no token. Then in here, we kind of introducing a token percentage to lock. That means that's kind of, I explain in a second to that. And then we need to be able to track collateral inside the contract. And also we want to kind of accrue some trading revenue for the liquidity provider or for the market creator. And what is very important is kind of the fixed end date, because you want to know when your market resolves, because there needs to be an end date. You want to get response for a future end date. But in this challenge, you will see if you do the challenge, we kind of it's not in there. So we left it out because it's just easier to test the whole thing and just to build it. So this is kind of the setup, and when you have kind of the setup in place, you can start implementing. And first, we're gonna look at the tokens. For the tokens, we just deploying an ERC20 contract here. So 2 contracts for both of these tokens. I mean, there are better ways. You can use an ERC 1155. Sorry for throwing all around these numbers. That means kind of you have one contract that can hold inside, so you don't need to create a new contract, different tokens inside, and you could just use that. But this is a more complicated, and I would just you use the easiest one in here. And in the beginning of the deployment, when you're putting out your contract, you kind of need to define how many yes and no tokens should be there. So for instance, we're taking in 1 ETH, and we're saying, okay, now our collateral is the 1 ETH, and we define, okay, initial token value. This is kind of the winning token value, I would say, when the market resolves to yes, how much then yes would get, would be 0.01, for instance. Then we would know, okay, we would mint 100 token each. So we would have 100 yes and 100 no token. And when we have that, we can also then calculate kind of the probability, like how it's done. And because we, like I said, we wanted to kind of lock tokens away, because in the beginning of a market, if you imagine there is nothing really locked away, and you would just make one trade, you're buying out 1 token, it would distort the whole probability. So you would get these spikes. So if there's 100 yes token, 100 no token, you're taking 1 yes out, then you think, okay, the whole market now bets on yes. So the probability that yes, of course, is 100. And this is just not, and then someone else would buy a no token, that would just kind of distort the whole market. That's why it's a good thing to lock away in the beginning some tokens from the liquidity provider, so you have better smoother trading. This makes sense. And also with the locking away of the token, you can define the starting probability. And this is I just put it here. When we mint away, we put 100 token away each. We want to have a starting probability of 60%. Then we just gonna lock away 12 tokens of the yes and 8 token of the no. And then we having in the beginning, when we taking the relation to each other, we count out, we having kind of the 60% in there. But just keep in mind, this is only because like the calculation is done right now, that we just always taking the amount of the tokens, and relatively we take the full amount, and that's how we can calculate the percentage for each sides. Does this make sense or does it not make sense? Maybe I need to come.
I guess it does make sense.
Okay, perfect.
No questions here, so.
Okay, perfect. So this is kind of the liquidity side. So when we're doing this, we set up all our stuff. Now we having kind of our tokens in place, so someone now can trade later. But first of all, we need to make sure that we have an oracle, because you always want to have someone to report what is the what is the result, and that needs to be kind of defined when you're setting up the market. So to the question, who will be on, if there will be human on Mars by 2035, we need to define already when we're setting up, okay, who is responsible to report the outcome when it's done? And is this really a reliable source? And that needs kind of a trusted source, because if it's just a source, I could just bet everything on no, even if it's yes, and then I just rock the whole market, and you don't want to have that. And that's where oracles come in play. And actually, an oracle is very simple, because Ethereum, like in a nutshell, the concept. So Ethereum is kind of a completely closed system, as you probably know already. So there's no real connection to the real world to keep it very safe, and no APIs, anything. It's just this whole with the nodes network. It's completely separated out. It just is running machine. But for this question, the prediction markets, we need to get some input from the real world. Huh? How does Ethereum know if a man was on the Mars or not? And therefore we need to report that. And in the end, an oracle is just a write function that sends call data into the blockchain and stores in a variable. And that's actually just an oracle. That's what an oracle does. But the thing is, like I said, how do you make sure this is a good oracle and this reports really the outcome? And therefore, we kind of came up with different oracle types and different functions. So the most easiest, maybe just staying here first. The most easiest thing, okay, we just choose a very, very trustful person that has no bad behavior plan or whatever. This is very centralized, and this one then writes the report into the blockchain. But I mean, that doesn't work, and I wouldn't trust on that if I would put a lot of money in it. So then you can think, okay, maybe we're grouping more people, maybe we're having even a multi-sig, and the multi-sig, then they need to sign, 10 people, and they're going to sign it. But it's still very weak, the assumption. And then there are other things. You can think of an oracle network, where then everyone around the world takes part. They're going to have a kind of incentivized in there. They take a stake, and then they get slashed when they kind of reporting bad comparison to all the other networks. So you incentivize the whole thing, and you can think that further and further. And I think a good example for that is Chainlink. They kind of run a completely decentralized oracle network. That's their Dawn, where they have many networks around the world, and they're all reporting prices into Ethereum. And if you're an outlier, you get kind of slashed. But it's also not the best, because Chainlink also curates the whole thing. So just a little nutshell, this oracle part is definitely not a good sole thing, and there is still, in my opinion, a lot of things to improve for the future of blockchains in general. And we're having kind of 3 oracles here. So, and that's what we kind of would use for a prediction market, is kind of an optimistic oracle, because it's just the open-ended questions, more or less. They're really hard to get. There's no clear API. I don't know which API I would take now for having human on Mars by 2035. So therefore, you would you would create an optimistic oracle, and that works like an optimistic layer 2, more or less. People can kind of post their answer, and it would be believed in the beginning if no one disputes it. As soon as someone disputes it, they have to make the proof. Then there's again a centralized authority. You see there's again a centralized authority. And then this person kind of gets slashed with their money put behind the answer. And the other person who kind of disputed it with the correct answer would then get his money. And so you let everyone post all the time. And if there is really a fraudster, it gets slashed and the correct answer would put on chain. Then the other type of oracle, and that one kind of we would use because it's like, but on the other side, we have also price oracles out there. And the price oracles are used for all kind of DeFi stuff, where you need prices all the time. Like for an Aave and all these kind of lending borrowing protocols, you always need direct prices. And there comes, for instance, the Oracle network from Chainlink into game. So many people reporting the prices, and then what's the medium is taken and put on chain. That's kind of what they're gonna do. And then we have also like, this is kind of this expert thing in very weird and subjective question. You would really then use human oracles. And I just call it, okay, that's like the example with a trusted person who sits in front of the computer and just gives their opinion and puts it in. That's kind of the three types of oracle. For us, it's the optimistic oracle. And how it's in the challenge done, there's just one write function and you call it like it's kind of a human oracle, more or less. Yeah, that's it, two oracles. So when we have the tokens and the oracles, we can report the answer. Now we can kind of start off trading in there. And the trading implementation for this one, I just wanted to show you, and then maybe how it's correctly done, is kind of very linear. Like you can see, I just put here kind of the distribution, if there would be kind of yes sold tokens and what the price would look like. So it's very linear. If you would buy 50, we have 0.5 cents in here, or a 0.5 ETH, because the winning token value in the challenge is with ETH instead of USDC, and it's going very linear, the price functionality. The big issue, and I don't go into here, is that it's very easy to implement, like it's done in the challenge, but it's actually not the best. Because you're having all kind of distortions in here, and one funny distortion when you're doing is that because you always calculate the average price in there. If you do a big trade, if you do a big trade, this means you buy a lot of token. That trade is cheaper than this one is more expensive than you would do with smaller trades. That's just because the average, you take a big average and a smaller average, and this is not a good thing. So therefore, I would recommend to go to other pricing models. And there are two pricing models out there. There's one that's the logarithmic market scoring rule, and this is a little bit more complicated, like you see here. And this kind of has the advantage that there's kind of infinite liquidity, so you can trade all the time in and out. But you need some subsidy. You need some trusted party in it who comes up with money in case there is money needed to kind of fund the market. And that has definitely a big potential of rug the pool and rug the protocol. That's why it's not so commonly used. And it's also because you see the formula here, it's very complicated to make in Solidity, or not complicated, but it's very gas inefficient and very expensive to do. And that's why most of the people more go here with the fixed product market maker. And maybe you know that from the DEX like Uniswap. And this is just this simple bonding curve. But the downside here is you always need these liquidity providers who putting money up in front. In our example, like I did, when we're gonna put into the market 1 ETH, and we're gonna mint against that 100 tokens. If these tokens get traded out, and everybody, I hold now 100 token, Lubos holds the other 100 no token, for instance, then there is no liquidity anymore to trade. What needs to be happen? That there's someone, the liquidity provider, injects more liquidity into the pool. So puts another ETH and mints another 100 tokens. And how the concept works, I don't know. I just go into it a little bit, and I think that's pretty cool. And that was definitely one of the very moments which I like the most when I was discovering all the different concepts. Is pretty cool. Is this AMM, this fixed product market maker concept? That means you have a pool, and I'm just gonna use here the pears and the apples, and they're sitting there in the pool. And on the other side, you're having users. And if a user now trades in and out of that one, he takes a pear out, or he puts an apple in. So he puts an apple in, and therefore he's then allowed to take a pear out. But then in the market, you have 4 apples and you have only 2 pears left. That means that the price of the pears goes up, because it always here stays on the curve. And now if you imagine you're taking out again another pear because someone puts another apple, then the price even changes more. And that's kind of leads other people to see that and say, oh, nice, pears are so expensive. I have a ton of pears. Now let me put them in the pool and take out some apples because they got very cheap, and I think they are too cheap. And this is kind of how this market works in Uniswap, but you can also use this kind of the same concept in predicting kind of the price with the yes and the no tokens. But you always need to keep in mind that you have that it never can be more than the 1 USDC. Otherwise, you just wreck yourself. Yes, and this is kind of the commonly most thing also from Polymarket, because it's cheaper on chain. It kind of has a decentralized liquidity approach, so everyone can kind of participate it. If you have this other model, this logarithmic one, it's kind of more centralized because you have one party you rely on. I mean, it's very family and battle tested. Everyone knows it in the DeFi, in the on-chain space. It's very predictable what the price does. In the LMSR and this logarithmic one, it just can spike a lot, and it's very hard to calculate. And here it's just more simpler to see, and it's kind of, I mean, that's probably the last point is it's simple to implement, and everybody knows how it works. And kind of the final considerations to building this. And this is what I want to go back to the beginning, is like what I said with the differences of the betting against a prediction market. And I wouldn't see like Polymarket really as a real prediction market. For me, this all goes more into the betting, and also it's culture. It's just like, okay, you're betting on sports event, you're betting on the most events, and it's kind of where they trimmed, and you see all these valuations where they're going. I mean, they're all trimmed to make a ton of money. Just bringing this betting market onto blockchain, just making a ton of money. But and that's why the whole markets of Polymarket are also curated in culture. So you cannot create just a market out of there, because it bears a risk, and the risk is explained here a little bit. Because if you don't pay attention, I just give an example again. So we're having just 1 yes and 1 no token again, and we're putting in 1 ETH. So each of these tokens would be, with a 50% probability, would be 0.5 ETH and 0.5 ETH. And when now only 1 person participates and buys the yes token for 0.5 ETH, and now the market resolves to yes, I, as a liquidity provider, have to pay him 1 ETH out. So I would lose 0.5 ETH when I'm doing this. And if you fuck that even more up, and you're starting with some skewed probabilities in the beginning, you just put the yes to 10% and the no to 90% kind of, and you start, and then the market resolves to yes, and you have only 1 person trading it, you need to pay this person then 0.9 ETH, because you only paid it for 0.1 ETH, you paid for the yes token. And this is definitely something to keep in mind. And this is also one of the main reasons why you don't have out there permissionless market, because anyone needs to be upfront coming in with to liquidity. But I think this is exactly the core, and what it should be is that these prediction markets are kind of truth-seeking markets. So you're willing, like a prediction market creator or a market creator in there, I put out a question and I want to have people betting on it or playing or put their information into prices. And I'm willing to pay for this in order to get kind of a probability outcome I want to use for something else. And this is, I think, the difference, in my opinion, or for me, the difference between betting and a prediction market. And The other thing I already mentioned is really about the question, because when you're thinking, I'm trying to build a kind of a predictionless, a trustless, permissionless prediction market, it's really hard to make people then create the right question. Because first you need to have the right question. This question was clear and precise and has a fixed end date. There is nothing, no one can debate about it. This is the one thing, and that's already hard to get. And the other thing is then finding the right oracle who can answer that and who is trusted. So there's just no disputes on it. So this is a very, very, very difficult task to tackle when you're going there down. You want to build a prediction market, and so it should be permissionless and so on. Then how do you bring users or creators of the markets that they create the question? And how do you then make them find an oracle that can report that, if this makes sense? This is definitely a thing, is not a big knot in my head, building these prediction markets, really predictionless, that there is no one interacting. So you as a user, or you can go there, you're going to post your question, people can bet on it, and then at some point it resolves with the right result from an oracle. Yeah, this is definitely some things, if you're more interested going into the prediction market route, a thing to wrap the head around and build something cool with it. And I would be happy if someone come up with a good idea and would like to support me. Yeah, this is in a nutshell building the prediction market. I want to highlight the most important things. I think when you're going through the challenge, I mean, everything is more described as well. You will see even more. Let me know if I just should go to the code or not, but I think everyone can do that better. I don't know how you're feeling about this.
I don't think it's necessary to go through the code.
Yeah, or show something. Okay.
I have a question related to liquidity providers. Are they profitable today, or are they losing?
They're making money. So I haven't mentioned that, and I forgot. Is like Polymarket, for instance, they're using a market maker concept. So they have an order book, and they're paying market makers to run that, and they're taking a spread out of it. So every trade they're gonna make some money. And Polymarket is definitely very cautious about the markets. So they do a lot of research before they're putting out the market. There's just a randomly created. Most of the markets, or it's kind of sponsored by someone, but most of the time, and these market makers making money. Polymarket itself doesn't make money right now, so they're paying all these fees they're gonna create in the spreads going to the market makers.
Okay, thank you. So, how will eventually Polymarket profit from this? What is their goal if they are not profitable right now?
I mean, they can turn whenever they want a fee switch.
Okay.
So they can start. I mean, there's already a spread in there, so they can also take a spread for themselves, or they can just be the market maker himself as well. But I don't have a lot of insights how they really do business and what is their revenue streams. So I cannot tell you exactly. This is just what I read, that the market makers right now make the money, and Polymarket operates for free. But they got a lot of funding, so VC is paying them. I think they raised another also $2 billion on that.
Yeah. Thanks. Are there any questions so far? I guess no. So you can continue.
Yes, and this is kind of the thing, what I find very interesting, and where I want to definitely dedicate more or my future time into it, is the whole thing with the agents. I mean, everyone is speaking about, well, what is the impact on these agents on prediction markets? And if you see these questions, for instance, will a CRISPR-based therapy for Duchenne muscular dystrophy phase 3 trials before Q3 2026? I mean, there is no one out there in the room, probably, I don't, who can probably answer that and has the information to it. And yeah, I mean, this is kind of an issue, because we were kind of talking about, okay, if you're going to Polymarket, it's all these public events, everybody's kind of interested in, but there's not these niche questions, actually. You want to get information for it. Because for this question to get answers, you need expert in the field. They are very hard to get. and if they would dedicate their time to solving this question or answering this question, you probably need to pay them a lot of money if you even get them. So this is kind of a thing out there. And the question is, how could it be that these kind of questions can be answered in the future? And I mean, we're having all these limiting factors for us humans. We're having the attention, where we dedicate the time on. Even if you get an expert for this question, is he dedicating time on this, or is he maybe rather doing something else, exploring something else? Then the focus and the complexity is really, really hard to get. I mean, I have no idea in this area. I cannot work on that. And if I should really focus on that, I'm not sure. Maybe I'm better in different topics. And then it's the whole emotional influence. I mean, we have seen this with the jelly beans and the question that get asked. So you can kind of getting this herding behavior in there. You're driving people in the one direction and creating these bubbles and stuff, but you want to get the real answers out and the real information. Yeah, and this is kind of the time where agents could come into play. Because, I mean, agents, if you think of them like individuals participating in the whole ecosystem out there, they also want to make some money to earn something. And it could be a good way for them collecting all information in special areas all together, consolidate and participate in these prediction markets. And if I want to know the answer, I'm willing to get the money out, even if I lose on that in a little bit. And I can just put a little ton of money in there, just a tiny bit, because these agents don't need so much money. They don't need to pay rent. They don't need to pay whatever. They just want to live and make some money out of there. And that could happen, that there are many agents just participating in these prediction markets. And that kind of would lead then kind of a Google of forecasting. So we can ask all kind of future questions in there. It will take some time, and then agent with the information around their specialized agent participating in the markets can spend so much time as they want 24/7 on it. And that could then lead to answering all these future questions. And then we would have real prediction markets that kind of are really giving me information about the future. And that's what I'm really curious if this would work out. I'm not pretty sure yet. The question is, where I would get these agents the real information from it? Especially to the first question I asked, they need probably very internal information of a company, but they are not public. They are kind of private information. Would there be a leak in there, or how would they know it? Maybe they have information around, but this could be a cool way, and I would like to see a platform where I can just ask these questions and just get my tailor-made answers to the questions out of it, willing to pay maybe $10 or so. Yeah, and that's kind of the overview from the prediction markets. Yeah, from my side. And of course, I would like to see you doing the challenge. And if there's any feedback, or you would change something or do something else, or you have other ideas, please let me know.